Hi, everybody. Thanks for joining us today, and welcome to the third webinar in our series on microfinance in the energy sector. This week's webinar is going to focus on best practices and business models for MFIs. Last week, if you joined us, we discussed the development of partnerships with product manufacturers and distributors. Next week, we're going to look at designing an energy finance product pilot. For those of you that were unable to attend the first two webinars, we are the Power Africa Off-Grid Project. We are a 4-year USAID funded program that aims to increase energy access through off-grid solutions across 12 countries in sub-Saharan Africa. I'm now going to pass the mic over to our presenters, Saiful and Pierre. Just a quick note, please type your questions in the Q&A box at the bottom of the screen. At the end of the presentation, we'll answer as many questions as we are able to. If we don't get to the question that you put in the Q&A box, we will be sending a mailer out after the webinar that will include a link to the presentation as well as written responses to all the questions that we receive. For the last two webinars, you should have already received the email that had the link to the first webinar along with the Q&A answers. If you did not receive that and would like to, please make sure to just type your email address into the chat box and we'll make sure to send it out to you. Thanks everybody, and let's begin.
Thank you, Anna. Good morning. This is Saiful. I'd like to take this opportunity to welcome all of you in this webinar series on energy lending. I'd like to take this opportunity to my colleague who will be with me, Pierre, as well. In the previous two webinars, we discussed how MFI can develop loan product to meet clients' demand, the importance of identifying good quality energy products, and the importance of building partnership with product companies. In the last 10 years, I have worked with some of the largest and successful microfinance institutions in the world, introducing energy finance. My goal is to share this knowledge and experience that I gained through this webinar series so that you can develop successful energy lending products and practices that attracts customers, build cost-effective businesses, maintain high portfolio quality, add new source of revenues, make profit, and attract new investors and banks. Next. Today's topic is best practice for working with microfinance institutions in energy finance. During the presentation, we will focus on 4 areas which are listed on the screen that you can see. I strongly believe that by the end of this presentation, you will learn about some of the inherent natural strengths of MFI that makes MFI an attractive energy lending partner for energy companies, key features of business models and their importance, successful business model for energy lending, their advantages, challenges, roles of MFI and product partners. As a result, you can also learn and adapt some learnings that suits in your MFI. I believe that at the end of the presentation, you'll be able to identify key elements of business model that you can offer to your clients. Improve alignment and transparency between head office, field staff, product partners, become cost efficient, and finally run profitable energy lending business. Next. I observed mainly 2 key barriers that hinders a small scale off-grid solar program to expand. Number 1, lack and access to financial support. And number 2, lack of existing last mile coverage. Interestingly, MFI have the solution for these two challenges. Let me explain. MFI have been in presence in the remote rural communities. That is why energy companies are very interested to work with MFI so that they can offer energy products by leveraging MFI network at a low cost. Number two, MFI offers small loans to low-income clients who usually cannot access loan from formal financial institutions. MFI increasingly acknowledge energy finance as a valuable product because it serves clients' demand and remain competitive. Two, it creates another lending subsector for MFI, which directly helps MFI's profitability and expands outreach. And three, it adds another revenue stream in the form of sales commission. In addition, it builds on clients' loyalty. Over the years, MFI build relationship with their clients, gain clients' trust and loyalty. MFI gave them often the first loan without any collateral, while no other financial institution gave them loan or even looked at them. Clients often consider loan officer as their trusted advisor. This lowers the market development cost and helps faster conversion of leads to sales. MFI not only have clients' credit history, but also knows clients' behavior. For example, who pays on the first day of the month versus who pays on the last day of the due date, and clients who needs to follow up and persuasion to pay installments. This knowledge helps MFI to reduce cost and loss as there are less delinquency, number one. And also, they can plan cash flow accordingly and help customize follow-up and monitoring strategy. I always advise MFI leaders that when they decide to introduce energy lending, they need to have clear understanding about their key strengths and weaknesses. This will help them to choose or develop business models that rely on their local context, strengths, and avoid areas of weaknesses. Next. So what is business models? Based on my experience, I think business model tells the story that explains how an organization works and make money by offering a value to the customer. Business model has several elements. Some fall under organizational efficiency and some what customer value that helps customer making buying decision, such as objectives of the business and how they're aligned with vision, unique value proposition that it creates for its customers compared to its competitors, customer segmentation and pain points, solution MFI offers to address the pain point, and what are some of the activities it performs to bring the product and services to clients. How is the cost structure? How they compare with the competitors? Who are the channel partners? What are their roles? So these are some of the elements. In my experience, I found that well-designed and concrete business model not only make business process standard and efficient, but it also extremely helpful to attract investors, banks to raise funds. Next. Next. Today, reaching the last mile in remote areas remains a big challenge for many solar companies. This challenge is true almost everywhere in the world, including Africa. As a result, the benefit energy products should actually reaching to the poor who needs them the most is not there. Solar manufacturers and distributors have been trying continuously find intermediaries to distribute their product, especially in the rural and off-grid areas, and in areas where electricity quality is poor. So what they did is initially they tried the traditional retailer model, but they found that it is not so good, especially for the last mile coverage. Moreover, it needs lots of investment for financing the retailers. Some product manufacturers, especially small solar product manufacturers who tried creating their own distribution network, they found that this model is good for larger products that needs installation and technical support. Besides, it takes a lot of investment, time, and effort. Product suppliers in the last few years have been using technology to distribute their products at a very low cost, such as PayGo. This model is capable of sending products safely to the remote areas at a low cost. I observed lots of companies are using this model in recent days. However, financing and after-sales service remains an issue. Solar companies have been very innovative about identifying pre-existing credible networks to offer their products, such as school teachers, gas stations, MFIs. In my experience, I found that every business model has certain advantages and some disadvantages or challenges. One business model that works well in one MFI or product company may not have similar success in another organization. Success depends on market conditions, clients' demand, organizational setup, policies and procedures, and finally organizational ethos. Therefore, there is no one model that is the best. Rather, what works for you is the best. Next. Based on my experience, I found that product companies find lots of value working with MFIs because MFI and energy company develops several models to deliver their products, which are listed here. A, MFI product company partnership model, B, agent model, C, loan officer model, and D, energy officer model. We'll discuss them in detail in the next few slides. However, before I explain each of these models, I want to highlight a few common strategies these business models considered, which in my opinion, the key elements for the success. Number one is credibility of MFI among clients and community. They have been working in the field for a long time, and they have very good reputation in the field. Number two is the relationship of loan officer, who is often the face of MFI. It's a trust relationship or trust. We often call them the trusted advisor of clients. MFI offers loan, which is very valuable. And finally, strengths of product partners that brings quality products. In the previous webinar, we said the importance of good quality product. They also bring marketing, promotion, and inventory management. Next. As you can see in this diagram that there are three main parties involved in this model. Number one is energy company or companies, two microfinance institution, and then we have the client who is receiving the product and also taking loan to buy the product. So what are the roles of different parties? Energy company market the product and takes care of any after-sales services and warranty issues. MFI takes care of the loan and client receives the product and services and responsible to repay the loan on time. In my experience, I have seen that loan officer usually introduce product company staff to the clients. Most of the time, this happens in the MFI's group meetings. Product company staff take this opportunity to demonstrate their products to get leads, subsequently follow up with clients to convert leads into sales. When client agrees to buy the product, the loan application comes to the loan officer to conduct the loan appraisal and place it for approval as per microfinance standard loan administration process. MFI receives a commission from these companies. The key element of this model that they leverage is client trust that the MFI will always work with good companies and it will never finance any product if they are not good. They have that strong trust. And number two is availability of loan fund. In my opinion, this model gained a lot of popularity among MFIs and product partners, especially for the following three reasons. Number one, product marketing is done by product companies, trained professionals. This model works best when MFI and product partner works in the same area also. Number two, for MFI, it is also low risk and also it's a low cost model as they don't have to do much extra job in relation to product sales and after sales services. Also, as a lender, it can also distance itself from marketing and sales of the product, while they can earn from interest and commission. Number three, MFI can also expand its outreach by extending energy loan to new clients. That's a way of expanding outreach as well. However, the success of this model depends on certain parameters. One is loan company, product company's staff may take longer time to convert the sales into leads into sales because of their workload, because of the time that loan officer have to give maybe. And number two is loan officer support to product partner, follow and commitment to the energy lending. Because loan officer needs to be committed to this program so that they take interest. When client asks them about the company, the product, they take time and talk with the clients and give their comments. If that doesn't happen, then this model suffers from success. Head office can play an important role to mitigate this issue through training and motivation about the importance of energy program for MFI. Based on my experience, I think this model is most suitable for MFIs working in a highly regulated environment or an MFI who is just starting and yet not ready to take a lot of risk. Pierre, have you seen in the West Africa this model?
Thanks, Saiful. Yes, MFI product company partnership model is, in fact, one of the most suitable and accepted model for our regulated MFI environment in Africa, as this model allow both parties, I mean the MFI and the product company, to focus on what they do the best, and it mainly allow the MFI to comply with local regulation. The MFI will mainly focus on loan application and processing, and could be also involved in some marketing and promotion activities inside these branches. Activity targeted at is mainly at existing customers. You may also receive a commission as well for these activities, in addition to the interest on loan. And the product company mainly will focus on marketing, sale, installation, maintenance, and other after-sale services. One of the biggest advantage of this model is both parties can start with the less possible risk and a very small investment, as they will mainly use the internal and current resource. They don't really require any additional resources. And our current activities in West Africa focus on this model, as ELO, MFI, maybe to increase the appetite on energy finance by learning a bit more on product when they work closely with the energy companies. Thanks, Saiful.
Oh, thank you very much. I think that was very helpful. So basically, what this partnership does is they work on each partner's strength. So MFI has the network, that's their strength. They have the loan product or finance, that's the strength. And energy company has good quality product. They have the product knowledge. They have marketing, promotion knowledge, which they share with microfinance institutions. And as a result of these two partners who are combining themselves, the model becomes very effective. And you are saying it's also low cost, because there's, number one, investment is minimum from both sides, and it's also less risky because they are not coming out from their comfort zone. So this is perfect to start the energy lending, which I advise to my clients that this is, if you want to start quickly, this is one of the way to start quickly. Next. Here in this model, there are 4 parties involved. As one is product company, which is not in the diagram, but this is one. MFI is there. An agent is involved. And as a client is our beneficiary or consumer who takes a loan or buy the product in cash. And if it is a loan, they have to repay. Product company takes care of agent training, provide marketing materials, and after-sales service. MFI branch conducts all loan and collection-related activities. Microfinance head office plays a supportive role of training staff, especially the change management for introducing the new product. They oversee inventory management, and they also monitor agents' works, how they are gathering leads, what is their conversion ratio, and what is their sales in both loan and cash. The key element of this model is leveraging agents' trust and doorstep services, because the agent is coming from their community, somebody who they know and who they trust. So this is added because MFI has the trust, MFI has the credibility. We are adding another element of trust and convenience in this model. I've seen that some microfinance institutions like this model for the following reasons. Number one is this helps last mile outreach, especially to the local community that MFI cannot even reach. Again, this is low risk and low cost model for MFI as well as MFIs, as staff involvement from MFI for promoting products and sales is minimum. And also, this model has huge potential to expand beyond existing clients and beyond even existing energy product. Basically, it is a way of developing sales channel, investing in developing sales channel. But these successes depends on some involvement from MFI, which is agents needs to be closely monitored. They need to be coached on sales. Also, I have seen that agents' market is limited by their own community and even their physical reach. Sometimes they ride a bicycle or they go by motorbike or they walk. And also, after splitting commission with MFI, agents may not get enough him or her to remain in this business for a long time. Pia, do you have examples that you can also share?
Yes, exactly, Saiful, thanks. Concerning the agent model, for example, many MFI in Africa use ag value chain stakeholders, and in some countries they are using mining stakeholders as well, as they may be the most active and most connected stakeholders in the rural area, where the demand for energy product is the highest. They mainly use in some area, like in Cote d'Ivoire, for example, they use fertilizer and other ag input sellers, or some other use member or a manager of a ag cooperative, women group. And the main advantage of using a cooperative, for example, is that they know a lot on farmers. They know, for example, about the farm size, about annual revenue of farmers, about expenditure of different farmers, the need of different farmers. For example, in country like DRC, for example, some MFI use mining counters, because mining was the main activities in this area, for example. So these people were very reliable people, because they have an activity where they have the chance to connect to most people in this area. So based on the country, MFI maybe see the need of using the most active and most reliable people in the area to reach end users. Thank you.
Thank you. Yeah, that was very helpful. And I think, in my experience, what I have seen, that agent model is more suitable for smaller MFIs, and also MFIs, again, those who doesn't want to take much risk, especially in the initial stages. Is suitable for them. Next. Again, there are three parties in loan officer model: product partner, MFI, and the client, who is again the consumer of the product and loan recipient, who needs to pay back her loans in installments. Product company takes care of marketing materials, after sales services, and staff training to train about product knowledge to the MFI staff, especially loan officer and branch staff. MFI branch promote and sell products and conducts loan disbursement and collection related to this activity. MFI head office play an important role of leading and managing the program, training its staff on change management and new products and processes, support inventory management, and conduct close monitoring. In this model, MFI loan officers simply add energy lending to their portfolio and in their job description. That means a loan officer, in addition to his or her regular microfinance lending related work, promote energy products for generating lead and converting them to sales. Typically, the loan officer will demonstrate energy products to their clients in their group meetings, or when they're visiting their clients, or when clients are coming to the branches, and they outline the benefits of these products and how they will pay off the investment. Loan officer usually gets commission for per unit sales. In this model, loan officer trust and close relationship is leveraged in addition to loan facilities of MFI. I've seen many MFI, especially those that are small and medium, they like to use this model for the following reasons. Number one, sales conversion is quicker due to the long-standing relationship between loan officer and client. This model is very cost-effective because microfinance institutions don't have to hire new staff, and it's easy to expand this energy lending operation in their entire network very quickly. But the success of this model depends on training of loan officer on energy product, marketing and sales, this is a huge problem because loan officers are trained to give loan, but they have to be trained on sales. But a good training program that is conducted by energy company actually can do wonder. I've experienced how loan officers has learned the technique of sales in very short amount of time and brought wonderful results. Also, to motivate loan officers in this program, it needs to be brought in their individual key performance indicators and performance metrics. And of course, incentive on sales is very important. Also, there has to be a very strict monitoring and supervision to ensure that clients are not over-leveraged. And also, if loan officer's workload is very high, she or he will not be able to promote energy product. So that needs to be in mind. Next. In this model, again, there are three parties like previous model: product partner, MFI, and client. In this model, function of product companies are same that I've been discussing, that market development, marketing, training. Same with MFI head office, that they have to offer the services that I have explained earlier. The change comes in this model is MFI needs to hire a dedicated staff for their energy program and place him or her at the branch level, who are commonly called energy officer or EOs. The responsibility will be promoting energy products, demonstrate products, educate client, help them understand about the cost benefit of this product. These activities help client to make buying decision. This model especially helps MFI to keep energy product sales separate from loan underwriting, which is minimizing lending risk. However, loan officer play a very important role in this model, who often considered as the trusted advisors for clients. For example, loan officer's introduction of energy officer give confidence to the customer. Also, regular follow-up of loan officer about the status of energy product and how things are going with the energy officer, and even responding some of the questions client have about the discussion with energy officer and clients, reconfirm and assure clients that he supports the product that energy officer is offering. I observed that this model is more popular among larger MFIs who are interested to invest in building a separate product sales channel in their branch structure. There are a lot of advantages of this model, such as number one, MFI often hire marketing professionals who is better explaining the cost benefit of the product to the clients, which leads faster lead generation and quick conversion of sales. They also use the word of mouth marketing technique in this model to facilitate sales quickly. I'll give an example. Number of times, loan officer told me that clients come to them before making the final buying decision, seeking their advice. So here it's very important that loan officer give time and talk with the clients. And third, this model has potential to expand to non-clients. I have seen large MFIs that started offering energy products using this model that are offering now cell phone, laptop, bicycle. So this is a sales channel that they have developed, invested in it, started with offering energy product, and now they're offering other products to increase their portfolio. But like other models that I explained, this model also has limitations. Therefore, the success of this model depends on the investment and time to develop the capacity of energy officers. Also, as I explained earlier, need of loan officers to support and collaboration and work together seamlessly. That's very important. So in these four models, what I saw that all parties involved in this model play their roles as per strength. So that is one underlying assumption or elements that makes the model successful. And then leveraging trusted relationship with clients to convert lead generation and sales faster. That's the second element. Third is use networks to serve remote areas for the last mile coverage. And offer loan to sell products. So these are the four models that I have explained. These are the major element that makes the business model attractive to the client. Next. So what are our key learnings? Based on my experience, I found that clients want to invest in good quality product. Therefore, they want to buy their product from trusted sources. They like to rely on MFI, especially loan officer. They feel confident that MFI will not make partnership with companies that are not offering good product. Number two, energy poverty and access to last mile is a complex and huge issue. Therefore, one model doesn't fit in all contexts. We need variety of model based on their strengths. I remember in 2019, I took a group of MFI practitioners to Bangladesh to learn about energy finance from one of the largest energy programs in the world. I observed that some of the participants were busy and eager to get the manual so that they can implement similar program in their respective countries. But it is not possible to copy and paste best practice. What they can get is ideas, and learn the principles that works in their own context. The policy and procedures needs to be developed based on your own organizational context and your business model. MFI need to learn about business and develop its own business models. Therefore, I often advise to MFIs to start with simple plug and play system and then move to finance more complex systems, or start with agent model or partnership model and then move to complex models. And number 3 is MFI needs to invest in staff capacity building and client education in order to implement successful and sustainable business model. I mentioned in the earlier webinars that reputed and proven long-term product partners can play a huge role in staff capacity building, market development, and client awareness building. One thing I also observed that microfinance loans are pull product, while energy finance is a push product. What do I mean? I mean the demand for working capital business loan does not need much marketing or persuasion, while energy product needs promotion and client motivation. I remember a discussion that I had with a loan officer who very clearly articulated why he was not interested in energy finance. He told me point blank that when he spends half an hour appraising a loan, general loan or microfinance loan, it increases his loan outstanding target, and also it brings more income for MFI. But when he spends similar time to assess a energy loan, which is usually much smaller, for him it doesn't make sense. I realized that in this case, loan officer was looking at financial benefit of MFI and missing completely about meeting clients' demand, MFI's mission, vision, and purpose, and the overall bigger strategy that MFI took in when they decided to offer energy lending. Therefore, when MFI decides to involve in energy finance, it needs to orient itself with the changes and invest in training and integrate energy loan in the entire business plan. In conclusion, I like to say that when you develop your business model, spend time to understand clients' needs and pain points. Determine your objective, identify partnership, and clearly define the roles and responsibilities based on strengths. Carefully review cost and strike a balance between risk and profit and tolerance of your risk-taking ability as an institution. Learn from best practice and apply principles, but not blindly copying it. Finally, there is no best model. Whatever works for you is the best model. With this, I would like to end the presentation, and it's time for question and answer.
Thanks, Saiful, and thanks, Pierre. We can now go to the first question. So the first question that we have is, in as much as we are touching on loan MFI, how is the grant financing stream being handled?
So I understand the question is like this, that so how grant finance helps improving energy finance? If that's the question, I think grant can be used for capacity development and client education those are the areas that grants should be used. And I have seen that that works the best. But in terms of subsidizing product price, in my opinion, and from my experience, I see this is not the right way of doing business. Why not? Why is not, I'm not suggesting this? Because clients are not looking for subsidized product. What they are looking for is good quality product. They want good after sales service. They want good warranty. So to come back to the question that you asked me, grant finance should be used for macro development or market development, and not the business model development or offering subsidized product. Pierre, do you have experiences?
Yes, thanks. In most cases, we see grant finances when the program is initiated by a public entity. Sometimes when it's initiated by a local government, for example, they may use grant maybe to raise awareness, or maybe to promote the program among stakeholders and rural people, for example. But we don't advise using grant, like Saiful said, in develop business model, or maybe in maybe help client by a system. But sometimes, as I said, it's used to raise awareness toward the program, for example.
Thank you.
Thanks, guys. Next question. How does dissemination of mobile banking support energy, financing, and development?
Pierre, you want to take that?
Yes, I can. Yes, I guess you mean mobile money, maybe, but not mobile banking, because mobile banking is still very low here in Africa, for example. Mobile money has a higher rate of adoption, for example, thanks to dissemination of mobile phone. So mobile money dissemination can increase energy finance, for example. Some MFI use, for example, mobile money to facilitate repayment of their existing loan, for example, and it help them reduce significantly cost. I mean, operating costs, for example. So instead of when for example, the MFI and the energy company are using the same system, for example, the existing Angara system, will allow the MFI, based on the chosen model, to monitor the system, and will allow the MFI to control the system remotely. So you can significantly reduce rate of non-payment, for example, and increase the success rate of the energy finance program.
And the example is a pay-as-you-go system, and that uses the mobile platform to buy power units for what they can use in terms of electricity.
Okay, thanks, guys. We have 3 minutes now, so maybe we can try to answer 2 more questions, and then we'll end there and provide written responses to the rest. So the next question is, ultimately, the MFI is providing a financial product. Are there specific regulations around energy sector governing MFI?
In MFI governed by not energy sector regulation but by in most cases. I can give the example of West and Central Africa, for example. Larger MFI, or maybe depending on the statute. For example, MFI register as a corporate entity governed by the central bank, and the smaller one, or the other one registered as association and NGO, most of the time governed by the Ministry of regulation from the Ministry of Finance, for example. So this is one of the reason, or maybe the main reason why we advise MFI to focus on providing a loan to for the end user, but not to involve mainly on selling product, but because they will face regulation. They can start doing so at the earlier stage, maybe to increase their appetite. And when the energy company is not based mainly in the same area as the MFI, but in the one, they will face the regulation, because part of the non-financial product, I mean the turnover from the energy product selling will increase the overall turnover, and they will face the regulation.
Okay.
Just a quick addition. I was working in Kenya with a deposit-taking MFI, which is regulated by central bank, and they started the pilot as a loan officer model. But at the time of auditing, the central bank gave an objection, and the MFI, deposit-taking MFI, they had to move to partnership model. So yes, for a highly regulated environment, there can be problem for MFI to do energy financing directly.
Okay, it looks like we won't get to a last question because we're at time, but as I mentioned before, we will definitely send out written responses to all the questions that we've received. I just want to say thank you to all the participants and to our presenters today. Hopefully you gained some insight into the energy finance sector with microfinance institutions, and we look forward to seeing you next week at the same time for the 4th webinar in our series. Thanks again, everybody.
Thank you.